Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, June 10th, 2019. This video is coming out late tonight. I had recorded one right after the close today and had just a bunch of technical difficulties with it with YouTube. So doing it over, and hopefully this makes it out to you guys before the, I think the cutoff for the daily digest. For those that are not members of the site, that goes out every day at I think 6 p.m. So hopefully I'll get it out before then. And if not, you can always come into the site. Public videos and posts are always accessible, so you might want to check in at the end of the day on rightsideofthechart.com for those. All right. Starting out here, what happened today is we had QQQ and SPY take out those levels. Here, let's start. Here's QQQ, the 183 level I was watching, and SPY took out the 289. 289. These are my max bounce targets on SPY. And so you can see what happened. We had, first of all, those bull flags from Friday played out, and they played out for an impulsive move. So that's technically significant event number one, let's call it. Remember, we had these strong advances leading up to these bull flag formations, and we broke out. And I said a couple things. When you have a bull flag, they're continuation patterns. You have a sharp move up, very impulsive unidirectional move followed by a level of consolidation, which takes the form of a flag or a pennant, and that occurs ideally on low or decreasing volume, which it had here. And then you break out. What you want to see, your buy signal comes on a breakout, and ideally you want to see it impulsive, which it was. See the big volume bar, and on a gap. Nothing's more impulsive than a gap up, because you left prices behind here. However, as I said, you want to watch that pattern, because a bull flag, by nature, by definition, once it breaks out, the move leading up and out of the flag should be as impulsive as the move leading up to it. In other words, what happened is today we rallied up and then reversed and wiped out all of the regular session, not the gap, of course. Remember, we gapped up, so we still closed up a healthy 0.5% or so, and 0.46 in SPY. But what's interesting is, number one is that's not ideal action for a bull flag. Now, we're still above the flag pattern, so that's number one. And more importantly, is we parked it right on the 289 level. You can see this is a close 288.98 on SPY versus my level 289, close enough, 2 cents off on a $300 security. You can't even, that's mere basis points. What we also have here is an uptrend line. I'm going to get to the charts of the futures in a second. So there's just a lot to point out today. So we broke uptrend line. That's a caution sign. At the end of the day, we closed up. So let me just not mix words here. You have to give today to the bulls undoubtedly, because A, they broke support, and B, they closed on it, and that's nothing at this point in time, at least as of the close, but a back test. So this is the bullish scenario if it holds up. But as I often say, you can't read too much in any one day. I'll definitely give this to the bulls today, but it's a lot like, and I said this in the trading room to somebody, there's many battles within a war. You can win or lose some battles and still win or lose the war. The war is going to be a bull or bear market. Are we still in a bull market, or is this a bear market rally that has about run its course now? And that'll be, we'll only know that for certain in hindsight. So I'm just giving you levels to watch tomorrow going forward. So that's it. So watch 289, should hold tomorrow. We should either start up from here or gap up. And if not, because remember, we did break this trend line, and we put in some potential bearish candles on the 60-minute, in the daily charts. I'll get to those in a second. And now it wouldn't be unheard of to see a back fill a gap. So the dotted lines there I just covered over, that was Friday's close. This was today's open. So here's your gap right here from about 289 down to the Friday's close there. So that would still keep the bullish case intact. But here's the way I look at this. With each of these levels that go tomorrow, because we do have a trend line break, we have negative divergence on the 60-minute charts, we have potentially bearish candles on the daily as well. So what you want to watch for tomorrow, do we lose 289? If we do, does the bottom of the gap hold? Because it should, for the bullish case, that is. And if it doesn't, then the same levels that were resistance on the way up, like 286.75, then become support on the way down. If and as each of those are broken, it it increases the chance that this was nothing but a counter trend rally and a much larger drop to come, especially because that would mean two things if we go lower tomorrow. Number one, the bull flag pattern didn't play out. And as I often say, fewer things in trading and investing are more bearish than a failed bullish breakout of a bullish chart pattern above resistance. So that would be a failed bull trap, or I'm sorry, yeah, it would be a bull trap, but a failed bullish pennant or bull flag pattern breakout. And again, that could have bearish implications, and I laid that scenario out on Friday. And let's look at QQQ. Before we get there, remember this move up was to be expected. We were short most of this coming down, the majority of the trades on the site, other than we have commodities, things we're trading, treasury bonds, and other things like that. But the buy signal came. There was a lot of evidence for this rally, and that was, of course, we had big, powerful divergences building on the 60-minute, and then there's your buy signal. It turned out to be a really good buy signal, and so we had closed all our shorts out right before that. That was the lows on Monday of last week, and in 1 week we put in this rally. It's a very extended rally. Again, we took out that first small wedge, then the secondary downtrend line, and then boom. And that's that so far. We are quite oversold. As I always say, oversold in itself is not a sell signal. We were oversold right here at this point. What happened? Well, the market continued to work higher. Now, those oversold readings eventually caught up, and we also built divergence on the 60-minute chart here, and then that marked the top and led to the whole correction. Now, I'll say this, that I don't expect to put in a divergent high. It is possible. In other words, what would that look like? Well, we come in, we continue to move higher, whether we backfill that gap or not. And then the indicators make lower highs like this. Certainly possible, like we had back here. I'm not favoring it. Why? It has to do with the longer term charts we'll get to in a second. I'm still viewing this as a counter trend rally in a much larger move down. And if so, you usually get one and done overbought readings. The other thing is to look at the PPO. We have a high level bearish PPO crossover. What do I mean by that? Well, the PPO is quite stretched. It came from all the way here up to here. You can see that's the highest level it's been in a while. And we have clean separation. If you look at the lines, the distance between the lines, PPO and the signal line, it's clean separation. You don't want to use PPO bullish and bearish crossovers when you have the lines flattening out and there's low volatility in the market, because what happens right here, you get whipsaws. They cross, when the lines flatten out, they cross back and forth. You want to see clean separation. Right here, for example, this was clean separation, and then boom, there was your bearish PPO crossover. That was a sell signal, and it told you to get out at the end of the first counter trend rally right here. It confirmed. We got out anyways. We caught that rally. I went bullish at the time, saying looking for a bounce, position long, and then reverse back into shorts there, as I'm trying to do at this point in time. So you can look at these things, and that's one of them right there. And again, so I'm still leaning towards that downside scenario, and the fact that this will just prove to be what I refer to very often as, I call it a momentum fueled overshoot. By that, we had tremendous upside momentum. There was, as I say, I love trading short covering rallies, bear market rallies. Rallies after corrections, and I was up long on most of that ride up. Just started scaling in short, added to, as my plan was, up to but not below these levels here. So today, once we went above 289 and the same level, comparable level we'll get to on QQQ, I am not adding, but I'm not stopping out yet either. Those levels will be covered in a minute, and but I will add if we start to move lower tomorrow, confirming the false breakout and everything else there. So that's the hourly chart of SPY. Here's QQQ. Same story down below. When you look at the indicators, overbought. Last time we were this overbought was right there. We didn't go any higher on QQQ. Once we became that overbought, we topped for a while, and then boom. So you got to be careful. It's not the most opportunity, the best time to be buying. Sure, in a strong uptrend, overbought can become more overbought or work itself out. But if, and that's a big if, yet to be proven, if this is a counter trend rally, it's usually one and done when you get that overbought. But you have the high level bearish PPO crossover. It hasn't yet happened, but the PPO line is turned down, and so on any downside tomorrow we look poised for a cross. Last time we had a clean separation of the lines was right here. Again, bearish PPO cross there. So let's see what happens tomorrow. If you recall, my max bounce, preferred, what I call my preferred max bounce target was about 183. I had the line at 182.93. You can see we popped that level today. Again, a lot of momentum following through. You can see the bull flags from Friday right there. Boom, boom. Right there, bull flag popped up impulsively, but again, they sold into it. Not a hard sell, but again, it sort of foils this. Again, it doesn't eliminate that yet, but ideally, you wanted to see more impulsive buying. Ideally, they should have took it up to this next resistance level before much of a reaction right there. Again, that's ideally for a bull flag. So they haven't failed yet, but they're not really playing out as they usually do, at least with that fade. So let's talk support and resistance. So we had that momentum fueled overshoot. They popped it there, and look, they came right in. I had the line at 182.93. We back tested it first at a low of 182.97 on that candle. Talking 4 cents on a 200-point security. That's for all intents and purposes. We hit it, and then we hit it again and closed on it. So that is the story of the day. The big takeaway is momentum fueled overshoots, broke resistance, again on face value bullish, and remains bullish until unless those levels go. So basically tomorrow, a red day helps to keep that bearish case intact. And as I like to say, a little slang here, the redder the better as far as tomorrow's downside. If we can backfill the gaps and then some, that's really where it starts to sharply increase the odds. If we come back down tomorrow, backfill the gap, that's one thing. Maybe we move up. But if we come on down through there, then it means certainly that bull flag was foiled. There was a bull trap there. The breakout also was foiled on both SPY and QQQ. And so that would then increase the odds that we're going to take another leg down, in my opinion. All right, let's look at the daily charts. Daily charts, we put in these potential bearish candles. These are what we call these shooting stars, potential shooting star candles right here in QQQ and SPY. Now, I always say this, your candles are going to appear in all types of within trends. They don't mean too much if they're bullish or bearish. Obviously, when you're in an uptrend, you look for bearish candles, or you could look for bullish continuation candle patterns. This is a potential bearish reversal candle here. So here's SPY, gapped up. Again, it's called a shooting star candle. But what you want to see, or at least what I like to see, is that's not a sell signal. It doesn't mean we reversed. You want to see downside follow through. You want to see a big red candle tomorrow. And again, redder the better. A gap down would be even better than just an open up around here and a move down. So those are the things I'll be looking for tomorrow. And if not, then like I said, they've already taken out resistance. And if they can build on tomorrow's gains, then that starts to quickly erode and chip away at the bearish case. The fact that this may have just been a one and done type correction. Let's look at a couple other charts here. Let's go to QQQ. Okay, here's QQQ. And here's the bigger picture. And a minute ago I told you why I don't favor, even if we're going to have a deeper, a decent correction soon, I don't favor divergent high, another thrust up on the 60-minute chart to put in divergence there. Possible, of course, anything's possible, but these are your big patterns. Here's that big bearish rising wedge back in last fall, broke down in about October in the market top. We broke down, back tested, and then we moved down, and we had, you can see, initial leg down, a counter trend rally, another thrust down, a bigger counter trend rally, another thrust down, and yet an even bigger counter trend rally, but the move wasn't done to here. So right here we had a quick counter trend rally, and this is exactly what's happened here. We had this rising wedge, it broke down, there's your divergent high. We had a relatively small but tradable kickback rally. We covered a lot of shorts there. I did mention that, going long for the bounce, getting back in shorts afterwards, and then another second bounce so far. The million-dollar question, and only time will tell, and we all have our opinions. I'll give you mine, and it's going to be right or wrong. But these wedge patterns, you take the widest part of the wedge, that's the measured target for the wedge. They far exceeded it. Why? And why do I remain on the the camp that this is probably just a counter trend bounce with more to come? Because of weekly charts. I won't spend time on there because I want to keep this video relatively short. Like I said, it's my second draft trying to do this and then tinkering around on YouTube trying to get everything working. But the longer term bearish charts on the weekly time frame are formulating where I think things are going, and why also that these wedges played out, or this one played out for such a drop. This one had a very, off to a very impulsive start so far, if there's more to come. And again, it is certainly possible that this, is over. This was just a correction after this, trend line break, and the market's going to new highs. Time will tell, and like I just showed you on the 60-minute charts, we'll start to see evidence soon. If we go much higher, at least the way I see the charts, we're really starting to chip away. We're still pushing the upper limits of what I figured be a natural counter trend snapback rally. And again, was very much expecting it, saying that it was likely with the divergences in the 60-minute charts and everything else. And remember this too, today was a powerful down day, a big up day, but that's how those counter trend rallies end. If you look at these here, you see, you're always obviously going to get green candles at or near the top. Here is a big green candle, and then the top came another big green candle. And I guess one of the takeaways is when the rallies were over, it was quick to the downside. So I'm either going to be right soon or I'm going to be wrong probably soon as well. But if that does happen and we get a reversal, don't underestimate how quick we'll go back down and undercut, probably test and undercut those recent lows, and that would be a big drop. So it kind of plays into why I was fine shorting the Qs on Friday. Remember, we had zero. We closed out all our shorts a week towards the end of, or middle to the end of the previous week. We had nothing but longs on the site last week. We closed out our Intel long today, and in fact, I'll get to that in a second. We nailed the 1 penny off the highs so far. I called that trade in early, and Intel was up more than QQQ. So this one trade alone, which we came into the day long, more than offset the losses on the QQQ trade. We had our KHC trade, Kraft Heinz, which was up 2 or 3 times what the market, 3 or maybe even 4 times what the market was up today. So on balance, all our, we have mostly long trades on the site, only one short, that's the QQQ. Now we've closed out the Intel. That sort of removes our hedge. That was one. Most of our trades now are non-correlated. We have some stocks and commodities as well, things that aren't correlated. Those stocks, like KHC, is not very correlated with the stock market, or hasn't been lately. But this was correlated with QQQ. So look at it that way. Effectively, now we've, by closing that trade out today, I've removed my hedge. So we'll get to this just chart here, and this will talk a little bit about the market. Before we get to Intel, let me do this. This is what I did in the other video. And I did this for members today earlier. So I'm going to jump back here, loop back to that trade I just showed you, the chart here. And again, remember, 1 leg down with a bounce, second leg down, bigger bounce, third leg down. So far we had the little bounce, a bigger bounce. Now let's put those in perspective. All right, so that first bounce, counter trend rally I'm talking about, after the top was in, was good for a 6.23% bounce. Took another sharp leg down. The bounce got bigger because the move is getting bigger. You're going to get bigger kickback rallies, 9.68%. Another leg down, 10.3% rally off that low. Then the big plunge to the bottom. So far, what's happened here? Very similar. Remember, I showed you a minute ago we had wedges break here. First bounce was relatively small. It was tradable, certainly almost a 5% bounce, but another leg down. 9.2% bounce. So for those of you, unless you either you're brand new to trading, or you were trading last and fourth quarter, maybe you just didn't know what was going on because the markets were moving so fast. But if you're of the mindset, well, God, this rally has been just explosive off, over the last week, and there's just no way that it's anything less than a move, beginning of the move to new highs and a resumption of the bull market. If you're of that mindset, all I'm trying to do here is tell you that is certainly a possibility, but I see absolutely nothing in this chart, 0 signs that say this isn't anything more or less than what this was back here. In fact, so far it's a smaller bounce. It's smaller than both those bounces that we had back then, each one going lower each time, falling shy of the previous one. That's the definition of a downtrend, guys. Remember, a downtrend in a security, a stock or an index, is simply an index making a series of lower highs and lower lows. That's simple. That's all we're doing right now. This is still a lower high than the previous high. So while this is possible, this is just every bit, and in my opinion, more probable than that. And it's certainly very possible now. So again, don't let the vigor of this rally, if you're new to trading, you trade long enough, you see that. And again, it was to be expected. I kept using the word explosive, short covering rally, and everything leading up to those lows on Monday. The divergences were intact. The market was falling to support levels. So very much a possibility. One more thing to look at here. That roughly 10% bounce, if I cut it from the lows right here, grab that, I'm going to measure it out in time, and you see my pop-up box to the left down towards the bottom. It tells me that happened over 9 days, calendar days, 7 bars, meaning 7 trading sessions. This one right here, from the lows to the highs, let's see if I got it there, 8 bars, 8 trading sessions. This one, lows to highs, today so far, we can't say it's over, 7 calendar days, 5 bars. So there could be another day or two, there could be another, we could rally another percent from here in reverse and still be right about on par with this one right there. So I just wanted to point that out, that from what I'm seeing right now, there's just not enough evidence in the charts to say that this is not at this point a counter trend bounce. Can't say otherwise either. We'll know soon, and we'll know if we get those reversal signs, or again if we pop higher. The first sign that it's probably more than that, of course, will be taking out your previous high. I mean, technically that means no longer the uptrend's at least not clearly intact. It doesn't mean it's the end of the world for the bearish case, but it certainly chips away at it, and it meshes to with those resistance levels that I covered before. All right, so that's that. Let's go loop back to that Intel trade and talk about that, and we'll wrap this up. Maybe look at the futures real quick. Okay, we closed Intel out, or I closed it out today. We took that based on several things. It was based on both the daily and the 60-minute charts. This is a 60-minute chart right here, hourly. We had a bullish falling wedge pattern. And more importantly, we had Intel extremely oversold on the daily time frame at a very, very solid support, around 43, fall to that support. So waited for a breakout, and then what happened is we entered the stock. It had this basing pattern right here, all this right here, it based, and then popped above here, went on, that was bullish, hit our first target last week, and then today I had the second target up here, third target right here, but I decided to close it early when it was at 47.18. The stock today hit a high of, went on right after that to tick a penny higher, 47.19. Doesn't mean it can't go up, but as of now, I feel very good closing that trade out. It does remove my hedges, any hedges because this is it's a tech stock, it's a semi, it's gonna largely move with QQQ. So not only was Intel closed the day a lot higher, but we nailed the highs getting out. So we more than made up for any losses in QQQ today. And I pulled this out. Now I want to talk on this trade a little bit. This was intuition, gut feel, based on where I think things are going to go. And I'd rather get out now before a possible gap down tomorrow on Intel, because I see evidence building of a pretty good pullback coming. So that's why I closed that trade early. Longer term charts, remember, $43 was a very, very, very solid resistance. I do this because people always ask, how do you do trend line drawings, support resistance levels? Well, you look for a lot of reactions. So right here, starting out here, we have a gap. Gaps are always very technically significant, or technically significant. Some gaps more than others. But then the fact we came in, we tested the top, we tested it again. That's 2, 3, 4, 5, almost 6, and again 7. So this is a well-defined support level, not to mention Intel was more oversold than it had been in years. So to me, that was a high probability trade. Even though we were, been bearish on the stock up here, bearish here, short both times, but at that point, I was looking for only a counter trend rally. Again, it goes into my longer term thinking. I'm going to get to that here in a second on the weekly charts and let you know that it's almost identical with QQQ. So we gamed a counter trend bounce. Can it go up more? Can it go to new highs? Anything is possible. I like trading odds. I like trading risk reward right now, and also sticking to a trading plan. I was looking for a counter trend bounce to get out. Yeah, I had some price targets a little higher, but again, I decided to pull this one for a few reasons early. So 6% gain right on the button. Can't go broke taking a profit. And again, that was a big level there. Now let's just talk on the weekly chart, and this will kind of drive home some of my thoughts on the broad market. If you recall, QQQ had a big bearish rising wedge last fall, clean sell signals, was adamant, and had those long-term price targets. We were going to go down, and that played out. Intel also. Intel, I was highlighting this stock repeatedly back in 2018 inside of this big bearish rising wedge pattern on both the daily and the weekly charts, stating that we didn't have a sell signal yet, but we would once it broke. And that's where it broke. And even before it broke down, I listed my targets right here, 42.59 and 38.27. And this at the time was I was forecasting what the drop would be based on where I figured it would break down. So we went up a hair more. So from the highs, we fell 26% instead of the 24 when I figured that wedge was ready to pop. We hit my first target to the button. And back then, just as now, my scenario was that we'd hit, and this is why I list multiple price targets. We'd hit that target, get a reaction. The bounce, I will say, went higher than I thought it would, just like QQQ. Not by too much, but it definitely went higher than I thought it would. Now, it wasn't as if I was short or anything. In fact, I was long off the bottom there. But what it did, just like the markets, it put in another divergent, a larger. It just simply extended the previous divergences that are already in place. So again, the first divergences certainly played out. They played out for a 26% drop. But just like QQQ, a couple things happened here. Number one, we had a failed breakout. You have QQQ or Intel and QQQ both breaking out above their previous highs, breaking out to new all-time highs, which then shortly thereafter failed. That is bearish technical event number one. That is bad for the bulls. That's called a bull trap. A breakout to all-time highs on face value is bullish because everybody that owns the stock, when it breaks out to new all-time highs, everybody's profitable. Nobody's underwater. Just like a stock going to all-time lows is bearish because everybody's underwater and you have a lot of trapped longs that want out. So the opposite happens there. So longs tend to pile and they buy breakouts to new highs because, again, on face value, they're bullish and usually a stock will go up. What happened here? Well, number one, as I said, breakouts that occur with divergence and overbought have a much, much higher failure rate. I would say it's close to 80, if not 90%. So this was to be expected. Now a lot of people don't see that. They don't are not paying attention to divergences, how overbought a stock is, other indicators there. So that was bearish event number one, and the failed breakout, and also the divergence. That would be number two, let's say. And so we fell down. We hit that target again. And again, that's why we scooped it long. But the fact we already hit my target once, I did expect a reaction here, or wouldn't have been long recently. But I only expect a minor reaction because we've already bounced off my target. And because we hadn't visited in a while, that's where I expected a bounce. Had we just done this, maybe we could have gone down through there. But we moved up high, we were very oversold, went long for all the reasons I just showed you on the daily and weekly charts, as well as this was the initial tag for the first time this year. And therefore, whether we can go higher, we could certainly go 15, 20% or more higher. But if this is what I think it is, and if Intel's heading to this level, then they will sell into it just as everything starts to look good, like today. So going back to that 60-minute chart I showed you, it couldn't look any more bullish on Intel. Why'd I close the trade again? Intuition. And again, it's not as if I'm short Intel right now. Short the Qs, but on Intel, I'll wait and see what happens. I'm not going to add any, like I told you guys before, also, we're above the levels. I'm not adding any short exposure right now in anything that's related to the markets until and unless we start to reverse. But that is my expectation, and that would bring Intel down from where we're at about another 19, almost 20% down to my next target. And I'm either going to be right on this and be right on the market as well, or wrong, because I very much doubt, although it's possible, I very much doubt Intel's going to drop another 20% from where we're at without the market taking another leg down. So I just wanted to say that, and also share with you that this chart almost mirrors QQQ and more so the developments and how it's played out. So there's Intel. And I could sit here all day long and make bullish cases, like I did a minute, earlier to go long. PPO, I want to see that signal. I want to see the PPO cross back down here, both that the PPO line and that signal line, and some other things there. All right, let's look at the futures and wrap this up real quick. All right, ES, the S&P 500 E-mini futures. We're looking at a 60-minute chart here. What you can see here is, again, just like SPY, where I showed you we had the divergences building. They took a while. They were building here, no buy signals. They were building here, and our buy signal came right there. That's that same falling wedge on SPY I showed you, and it was a golden entry. And that's why we didn't have any shorts until Friday, all longs on the site. And so that was led for a nice rally, and this is what you see. This is very typical. It doesn't mean it has to be a bear market rally, but if so, this is just exactly what a bear market rally looks like. They're powerful, strong. Hope comes back into the market. People believe the worst is over, and they want to get back into those beloved stocks, FANG stocks, or anything they can buy because there's been a dip. Everybody on TV tells them to buy. And the news headlines, of course, turn more bullish at that point in time, and then boom, it's over. And it's also exacerbated. The reason these rallies are so strong, it's not just natural buyers. A lot of this is short covering. Those that were wanting to short back here when they should have been looking to cover or position long, they shorted, they started getting squeezed, and they can continue to get squeezed, and probably most of them squeezed out by now, I would have to suspect. All right, so forget about what's happened. Let's just talk about what to watch going forward, and that would be this. As you can see, I've had resistance here at about 2,900. SPY popped that today, but it failed. Failed breakout of that level. It's not a super significant level, but it roughly correlates with the level I showed you on SPY. I'm sorry, this is ES. I keep referring to this as the futures. So what we want to watch, we put in a divergent high. Actually, the divergence has been building, but it's starting to steepen here. You can see negative divergence here on the PPO RSI as we put it a new high today. So you have this price channel defined by that line, which is also a divergence line, and this line right here. SPY, or ES, I'm sorry, cracked below it, but only slightly, and NQ didn't break down, so I'm not going to call that a sell signal yet, but it is a level to watch. The more we move below there, if we continue overnight or tomorrow, that will be a breakdown, and that would be a sell signal, and that will most likely, depending of course what NQ does, and QQQ, most likely bring us back to at least here. So the same resistance levels that acted, or same levels that were resistance on the way up, should then act as support on the way down. But we do have, again, for the first time now in a while, or well, it's been building, some divergences there, a very overbought and extended run with a clean, well-defined uptrend line in which to trigger a sell signal, also a resistance level where we failed so far. Let's look at NQ. NQ, you can see we're a little more comfortably above the uptrend line. Here's the 60-minute trend line, the way I have it drawn right there. Here's our price channel, also a divergence line right there, negative divergence you can see at this point. So that's really right there on those highs. And so these are the levels you want to watch tomorrow. You want to watch for this trend line. Obviously a break, an impulsive solid break below would be bearish, while let's say we pull back, there's support right here about 74.81 or so. That would be bullish. Keep the trend up, or pullbacks to the trend line. If you're bullish, you could buy that. And if you're bearish, you want to look for a break of that level, 78.41-ish, and the uptrend line. And you can also see the flags. Remember, we had those bullish pennants or bull flag patterns in the futures on Friday, and they were really nice looking too. And there's our flagpole right there. But what happened? They kind of got foiled. We didn't drop below it, but the symmetry, this really stretched out. That doesn't mesh anymore. And again, that's Sunday night trading. So again, I showed it to you on the ETFs which trade during regular hours. They played out, but then reversed. Either way, you can look at it this way. You can look at a lot of ways. There's your flagpole. There's your measured target, almost hit, and then we started to reverse. So those are the levels to watch. And with the divergences, I'm still favoring the downside, but I need to see us come back in now before I'll add any more short exposure. Otherwise, I'm more concerned if we push up, and like I said on SPY, going back to that, where was it? No, QQQ, I'm sorry, because that's my main focus right now. On the QQQ 60-minute chart, 186. That's the level where I think the bearish case starts to chip away pretty quickly if and when we get above 186. So that's, although this was what I called my preferred max bounce target there, meaning I'll scale into it, I like it, I'll sit back here, and anything above there, as far as if we take out that level, that's where I'm concerned on getting out, starting to scale out and say, you know what, maybe something else is going on, maybe we're going up to new highs. Finally, RTY, small caps, every now and then I cover those. I'm going to follow them every day. I'll cover them in the video once in a while. Nice bullish falling wedge. Again, the setup on the long side was building the divergences we're building, and then we got the buy signals, which are breakouts. That's what happened there. So so far after the breakout, what we've done, just like SPY and QQQ, we now have negative divergence, just like we had bullish positive divergences there that launched were the catalyst for the rally. We now have negative divergences and a little wedge type pattern. Same story as ES and NQ. Here's your trend line, so you can watch it on all of them. Large caps tend to lead the market. Sure, the small caps will move in different directions at times, but the more of these breakdowns you get, if you get them soon, the better the sell signal. Break of all these trend lines, ES, NQ, QQQ, SPY, etc., RTY, again, small cap futures. And if so, you get a breakdown, you might be able to swing this back to 1496. But I'll tell you, if we get an impulsive breakdown, we get that low, and if it happens tomorrow or early this week, it again will increase the chances that this was just a counter trend rally that's over. So depending on what you believe, you can either try to game a quick pullback trade, get long or cover a short, or just if you're short, or if you're going to short on a breakdown there, just trail your stops down and allow for what I call a potential runner trade, because I think that's certainly a possibility right now. All right, we will wrap it up here. Long video, and I'll try to get this out to you guys as soon as possible. This has been Randy Finney with the Right Side of the Chart. Have a great day.